Hello, everybody. Thanks so much for joining us today on Tax Day 2025. I hope you're all doing well and feeling a little weight off of your shoulders this morning. We're really excited to have with us today Clark Holt, a wealth advisor here at Elevate Wealth Advisory. Clark has been with our firm over 20 years. In 2023, he celebrated his 20th anniversary. He's very wise on a variety of different subjects, but one that is always very intriguing is behavioral finance and what that means and how it affects your portfolio negatively or positively. And so we always love having Clark with us to talk about the subject. We did not know when we scheduled this webinar that our office is actually moving to our new headquarters tomorrow. So it is really special that Clark took time out for us today amidst the move. And we're very excited to welcome you all to our new headquarters very, very soon. So we'll be sending out more information about that and about our grand opening, and we're hoping you all can join us. But now I will introduce you to Clark. Clark has been, as I said, with us for over 20 years. He is the second most tenured employee at our firm after our founder, Chuck Vickery. Our firm Elevate was founded in 1982 by Chuck Vickery as Vickery Financial Services, and it was with the goal of helping people make smart decisions with their money. Today, we're still doing that, but now we have expanded to a team of 13 people to help you in your wealth journey from beginning to end. And I'm so happy to have Clark with us. Hi, Clark.
Hey, Betsy. Thank you very much. I appreciate it.
Glad to have you here.
Glad to be here. So yeah, the move is happening very quick. So I tried to leave a few decorations in the background so it would look like we're still in full force.
It looks great. You don't even need one of the fake backgrounds. It looks
I know.
great.
I know it. So we'll go ahead and get started. And thanks for that introduction, Betsy. I appreciate it. This webinar is really centered around behavioral finance, but not getting too technical on some of the terminology there. We're going to go through some of that, but I'm trying to tie it back into how it affects us, like Betsy said, how it affects our portfolios on the upside or the downside and our long-term goals. And also really share some perspective, because a lot of the ways that we can overcome these challenges that we're going to talk about is if we have the right perspective and we understand how markets work, it can really help us. And it's an ongoing process. It's something that we have to train ourselves and our minds to get through. And so I'm going to share my screen real quick. Just bear with me 1 second. So everybody should be able to see.
Looks
the
perfect.
First page. Okay, so how we can avoid being our own worst enemy when it comes to retirement planning, when it comes to investing. And I've pulled together a lot of good slides. I think there are more slides I could have added in, and so but in trying to be as respectful of everybody's time, I think it's the best content that I could pull together and keep this thing in a probably under 30 minutes or 20 minutes or so. So we'll get started. There's a famous author who has written a lot of books about investment professionals and investment advisors, and he's geared towards coaching wealth advisors like us. He's been around for quite a long time, and one of the quotes that he has said in public and in some of his books is, "The dominant determinant of long-term real-life returns is not investment performance, but investor behavior." And that is so true when you think about it. And our minds we're just not wired for disciplined investing. When we see things at Walmart or Home Depot or Target that are discounted or that are on sale, that's where we understand there's value there. With the stock market, it's almost counterintuitive. We sort of think that, well, investments are down, this is not a good time to invest. And actually, you want to buy low and sell high if at all possible. So we do want to look at some of the things, like if the markets are going down, we get upset that we should have seen that coming. It gives us a kind of a bad taste in our mouths if we're on this journey and we have a plan in place and we go through a 2-3 year down market. And some people think they have these strategies for picking winning investments or winning investment managers. And another thing that we see a lot is people doing their own research and coming up with a system where they feel like this sector or this company or this region will outperform. And the truth is, even the professionals that are forecasting and predicting, they have to make a prediction, but nobody knows what the market's going to do. We can make some judgment calls based on how the market's been performing. If the market's been down for 2 or 3 years, we should expect that it should recover. So, that's common sense. But again, our brains are just not wired for that disciplined long-term investing. So it's not just a numbers and data game, it's a behavior game. And so understanding kind of the psychology behind this helps us, really puts us in position for having a positive long-term experience. So we're going to cover some psychological factors that influence investor behavior, what the consequences are, and then just talk about ways that we can have that positive discipline mindset so that we can be set up for that long-term investment success. So 5 common investor biases, and there are lots of investor biases, but these are sort of probably some of the most common. One is loss aversion. And so what that means is we feel the pain of losses much more strongly than we feel the pleasure in the gains that we get. And that's tough to overcome. It's human nature to feel that way. This often leads to holding losing investments for too long, or maybe selling investments that have done really, really well too early. Another one, number 2, is confirmation bias. And this is where we're seeking out information before we make an investment decision that's supporting an existing belief, and not looking at any other evidence, if you will. So this can reinforce kind of poor investment decisions. And that leads again to suboptimal outcomes down the road. Number 3 is overconfidence bias. This is very common. It's human nature to feel this way, but if we're overestimating our knowledge or our ability or control over the outcomes, that can be hazardous to our wealth. And so this can lead to excessive trading or taking on too much risk. And we see this a lot with people that are managing their own money. That overconfidence bias comes into play, and that can lead again to lots of different things, but the excessive trading or taking too much risk can also create taxes, things like that. Number 4 is recency bias, and this is placing too much weight on recent events or performance. And this can cause us to chase performance or panic during downturns. And so when we have a week like we saw recently with the tariffs that were announced, multiple days the market declined, had some significant declines. And so we're looking at this event and we're thinking this will continue. And so we panic. We can also chase performance to the upside. So we see, like in 2023, the market had a great year, and people tend to, if they're maybe conservative, they tend to jump on that bandwagon, looking at that recent performance as sort of a guide, and then feeling like it's all clear. And so that can be a problem, certainly. And then 5 is herding behavior. So this is extremely common. And what we're doing when we're talking about this is these are, crowds of people that follow trends that they hear about on the financial news media, or they hear about from their neighbors or their friends or coworkers. And this is sort of fear of missing out. And so, oftentimes if Bitcoin's doing very well, or if gold's doing well, or if the stock market's doing well, people talk about those things with their peers, with their families, with their coworkers, and it sort of plants a seed. And so that herding behavior can really lead to these bubbles that we've seen over the years and very ill-timed investment decisions, if you will. And all these biases, every one of them, including the ones that I did not mention, and there are others, they all result in suboptimal decisions, and that just hurts our returns. So emotional factors, it's often that we're fearful, and that causes us to sell when the market declines, maybe not in one day, but maybe over a period of time. And so we sort of throw in the towel and we sell at the wrong time. And then on the other side, when markets are doing very well, we tend to get excited, and maybe a little greed creeps in. And this drives us to chase maybe more risk than we should, or maybe a hot investment that we've seen perform very well after big runs. And regret leads to holding losing investments. So we pick investments and we tell ourselves we know they're going to come back at some point, and we sit on those and we let those just stay in our portfolios. And that's where we want to be careful and not stick with losing investments for too long, and also not selling winners too soon and taking profits. So, and we'll get into more about the perspective of the long-term investment plan. We're really not having to worry about, should we sell it, should we buy more? Because when we structure our portfolios the right way, we shouldn't have to worry about that. So we just know that there's disciplined rebalancing, we've got the right structure, and we're globally diversified. And so, and lastly, uncontrolled emotions can lead to buying high and selling low. And we have all these emotions where when the market's doing great, we're optimistic, we're elated. We tend to, when markets are going up and our portfolios we see really, I would say, strong positive returns, we're so much more eager to add more money to our accounts at that sort of that elation period. And then a lot of times that nervousness can set in because we know how markets work. They go up and down. And when the market goes down, we get nervous. And if it goes down too much and for too long, we get fearful. And these are where big mistakes can be made. We can put more money in at the elation phase, and we can actually maybe even sell or go too conservative in that fearful phase, if you will. And just every time we do that, if that happens as an investor, we're hurting our long-term outcomes. So some consequences of poor behavior, we've talked about a few of these. Excessive trading can lead to high fees and taxes. If you're trading, or you have an advisor who's trading in a taxable account or tax advantaged account, not a retirement account, there are taxes to be considered, obviously. So you've got to be very tax aware. But excessive trading can certainly lead to that. And we want to try to avoid that if at all possible. It leads to concentrated, undiversified portfolios with higher risk. I've seen this from people that have come to talk to me who've had some success, but the conversation sometimes is, this is too concentrated, you're not diversified enough, and that leads to higher risk, which in turn can lead to the emotions that we've talked about, those biases, if you will. And then deviating from long-term plans and missing out on that compound growth. So when we work with clients, we're constantly trying to reiterate that you have an investment plan. It's tailored just for you. It's a multi-decade plan, and we've got to stick with it, or we'll miss out on the returns that are there for the taking. And going into number 4, or that 4th bullet point, just failing to capitalize on market returns over full cycles. So to get the returns that are there, that are offered, we have to stay fully invested through all cycles. And then lastly, failing to achieve our long-term financial goals. So that's the most important thing, because we've set goals for ourselves, our families. We've saved and we've worked and we've earned, and so we want to achieve those long-term goals. And if we have poor behavior, we're setting ourselves up for failure. Vanguard did a study, and I have a lot of respect for Vanguard. Many of you know who Vanguard is, very large investment manager. They have been around for quite a while, and they did a study, a very in-depth study, and it came out of their group called it's called Vanguard's Advisors Alpha, and it found that investors that work with a human financial advisor boosted their investment returns by up to 3% per year. And there are lots of different parts of that, or parts and pieces of that, but about half of that benefit, they say, came from behavioral coaching, helping people not make big mistakes at the wrong time, encouraging people to commit and add to their portfolios when it doesn't feel right. And so that study it's a great white paper that they did. And so again, about half of that benefit comes from the behavioral coaching. So we know markets over the long term have rewarded investors, long-term investors. And so here's just a quick look at going back to 1926, and $1 grew to, in small cap indexes, to almost 40,000, and in U.S. large about 18,000. And then we've got the long-term government bond index, T-bills, and then inflation. And so that looks manageable from a behavioral standpoint, like, oh, I could do that, I could survive the dips. And so, but if you really look at this, you can see it's that permanent upward trend, and it's just punctuated by these temporary declines. But when that happens 1 year, 2 years, maybe 3 years in a row, it's a lot tougher to get through those periods and not do something that could cause us to have bad behavior or poor, make a poor choice that's going to hurt our long-term goals. And so we know markets go up over time. Another way of looking at that I think gives us optimism and perspective is if we look at the history of the S&P 500 from 1926 through 2024, and you can see the bull markets and the bear markets. And a bear market is just a decline of 20% or more. What's neat about this is the length of time that we're in a bull market, but also the strength of the returns, how much stronger the returns are. The majority of the time, the market is giving us a positive return, and it can last for quite a while, and we have to stay the course to capture these returns. We've been through a lot of global events over the years, and this is just a slide looking from 1970 with all the different things going on in the world in the 70s and the 80s. The one that sticks out for me is the dot-com crash of 2000, and then 9/11. That was really my first year as a financial advisor, and so that really sticks out in my mind. And seeing that it took a couple of years to recover, but when it did recover, it was a very strong recovery. And then stretching that out up until this point, the returns look very, very strong. But we have to get through these periods, and sometimes it can be short term, sometimes it can be more 2 to 3 to 4 year, if you will. But there's always something going on in the world that can cause the market to decline. It could be terrorist attack, it could be Eurozone debt crisis, Brexit, fiscal cliff worries, all these things. But the market is resilient, and it finds a way to give us that long-term positive return. And this is actually just all 2024. So this is calendar year 2024. We were dealing with inflation. We were dealing with, averting the government shutdown, housing, U.S. housing starts fall to a 4-year low. In July, Biden dropped out of the presidential race. There was job market a little bit weaker. I mean, all sorts of things going on throughout the year in 2024 that could give us pause. And the return that year was positive. And so we have to stay invested through global events in the United States, policy, inflation, rates, all those things. We can't control any of that. What we can control is our behavior. So we talked about, I mentioned earlier that forecasting and us looking at what we think markets might do. And these big Wall Street investment firms, they all make predictions. Every year they make predictions. And so if we look at JP Morgan, Fidelity, and Goldman Sachs, they had made some predictions in late 2023 that were not, I should say, were not very positive or optimistic. And then, two of the firms in June of 2024 sort of walked that back. And it's almost like they don't know that they don't know. And once the market starts to prove them wrong, they'll change sort of their forecast, if you will. And so you've got a prediction, and this is a process. And then you've got sort of like, okay, now we think things are going to be much better. We think the market's going to finish higher. The U.S. is resilient. And so we can't worry about the financial news media or the so-called professionals telling us what the markets might do and let that get in the way of just having our long-term plan, investing when we have the money and not trying to time the market. And this is just a quick look at forecasts for lots of different firms for 2024. The forecast ranged from 9% to all the way down to maybe negative 12, a range of forecasts, and the market ended up with a 23.3% return. So all of the knowledge and skill that these people believe they have, and they do have a lot of skill, I won't doubt that, or knowledge, but trying to predict what the market's going to do is impossible. And so, and the long-term average is a little over 10% for the S&P 500. Another way of looking at the U.S. market is this Center for Research and Securities Prices, which is basically an entire U.S. market index, largest companies all the way down to the smallest. So this is a broad view of the total U.S. market. And they're ranked, each of these boxes is a calendar year from 1926 through 2024. And they're ranked by returns, negative or positive. And what we see is that really 75% of the time we experience positive returns. And we know that we're going to get some of those negative years as well. But what you'll see is the range of returns are much stronger. And again, the majority of those positive returns are coming in that 20 to 30% range. So this information can give us a lot of perspective, but it's not something we get and we just sort of we're all good. This is a work in progress. We are constantly challenged as we go through life events, market events, economic events to remind ourselves that this works. Let's avoid those bad behaviors, keep our heads down, and stick with it. So if we are tempted to have poor behavior and we miss out on the best days in the market, it can hurt the results that we get long term. And so this is just a look at the S&P 500 index from 1990 through 2024. And if you stay invested that whole period, your return is just over 10%. But missing just a few days can alter that return. And you'll see the returns at the bottom, and you'll see the dollar growth of a $1,000 investment. So if you just happen to miss the 25 best days, your return gets cut in half you miss the 15 best days or the 5 best days, again, returns are a little bit lower. Ending value or the growth of 1,000 is less. And so the point of this is we cannot time the market on the upside or the downside. So we have to stay invested for the full cycle. And the cycle really is as long as we're alive and as long as we need income, to have a sustainable income, we have to stay invested. And so that's a multi-decade journey. This is a look at how the S&P has returned after it hits new highs. Because sometimes we're tempted to think, well, if the S&P has just hit an all-time high, we think maybe that there could be negative returns on the horizon. And so on average, though, the positive returns are still coming after that high. And so another way to look at getting some of that perspective on how markets work. And this is just another look at the S&P on the annualized returns after the market declines of more than 10%. So 1 year, 3 year, 5 year, again, very robust, positive returns. And if we even look at recessions and go back to 1976, and we'll just, for this slide, it's through December 31st, 2022. The 1 year average after recessions is positive, but look at the 3 year average and the 5 year average. So ahead of a recession, markets may decline. We may have a 15, 20, 25% decline, which can really test our nerves. But if we hang on, markets recover even after recessions, and we get these very strong positive returns. So again, I keep using that word perspective, but it's very true. It helps us to know how markets work, looking at downturns and recoveries. And so downturns are just natural. We know that. We have to tell ourselves that, though, repeatedly. I reiterate that with clients. They happen with uncertainty. They can be, or negative events cause investors to sell, and this could again lead to declines in prices. And so downturns really can feel unsettling, but we know if we look at history, they're temporary. Again, just that permanent advance punctuated by these temporary declines. And markets have always recovered, and usually much stronger than in longer stretches than the downturn. And so recoveries can come from, could be economic growth, it could be optimism, innovation, things like that. But just staying disciplined during the market volatility is so key. And we don't want to miss out on those recoveries, because when they come unannounced and they come very quickly, and that can impact our long-term returns. So in short, we know the negative downturns can test our patience, but staying the course, we're going to be rewarded for that. So this is a look at calendar year market returns for the U.S. market from 1979 through 2024. And also on this slide, we've got the largest intra-year decline and then the largest intra-year gain. But the blue dot is the ultimate calendar year return. And so what the takeaway is for me here, and that I want you to understand, is that most of the time we're getting these wild swings to the upside and wild swings to the downside during the year. And actually the average, depending on, it's somewhere between 14, 15%. That's sort of the average drawdown in any calendar year at some point. We don't know if it's April or October, but ultimately the calendar year return is positive, and sometimes it's a very strong number. So again, this gives us that optimism, that perspective that we need to avoid these behavioral biases, if you will, or these issues, these poor behaviors that can cause us to impede our long-term plan. So we always tell people, focus on what you can control. And that's have an investment plan that's strictly tailored for you, your needs, your risk tolerance, not your neighbors, not your coworkers, not your parents or your kids. It's for you. And again, risk tolerance and understanding risk tolerance is very critical to what we do. We want to structure portfolios in the areas and we call it dimensions, if you will, that offer higher expected returns. We want to diversify globally. You want to manage your expenses, your turnover, and your taxes. And then lastly, stay disciplined through market dips and swings. So Benjamin Graham was a famous investor. He taught at Columbia. He taught Warren Buffett actually at Columbia, and he's got some great quotes that I've pulled together. And I'm just going to go through these real quick. Some of the quotes that I like from him: the investor's chief problem and even his worst enemy is likely to be himself. That goes back to that first quote we talked about from Nick Murray. Successful investing is about managing risk, not avoiding it. And another one is thousands of people have tried and the evidence is clear. The more you trade, the less you keep. And the last one, individuals who cannot master their emotions are ill-suited to profit from the investment process. And again, when I said this is a work in process as far as managing our emotions, we spend time reiterating with our clients over and over and over all the things we've talked about today on this presentation, so that they can stay optimistic, grounded, long-term focused. So really, what are the things we can do just for better behavior? We've got to have patience and discipline. We talked about that earlier. Sticking to a well-crafted investment plan, having a philosophy, having a plan, and sticking with it. Diversification. So we want to spread our risk across different asset classes and sectors and regions. So we want to be globally diversified. If we can, maybe through our workplace retirement plan or in other accounts, we want to invest systematically. It's sort of set it and forget it. So investing a fixed amount at a regular interval. And then we want to rebalance, just periodically adjusting our asset allocations to maintain those desired risk levels that we've set. That's very important. And then strategies for financial success. Your investment plan should be dictated by your goals. Again, not your neighbor's goals, not your coworker's goals. Everybody has a different situation. They have different dreams, goals, and they have different circumstances. And so it's got to be tailored and dictated by your goals. And we've got to stay in the market. We cannot time the market. So it's time in, not timing the market. Having that investment plan or investment policy statement that kind of governs our decisions, knowing why we're investing the way we are at that risk level and being comfortable with that, and then revisiting that if we need to adjust as you get older. And taking a strategic asset allocation approach that's just aligned with our goals and risk. And then again, use that dollar cost averaging, that rebalancing. And lastly, it's about planning and perspective. That's so important. That's what it really boils down to, is planning and perspective, having that right perspective, because that can help us get through and overcome poor behavior. All right, that concludes the presentation. There's a lot more I wish I had time to share. Maybe we'll do that next go around when I'm presenting again. And so, but this is a passion for me. I do love the behavior part of investing and helping people stay the course. And so I hope you enjoyed it.
I thought it was great as always. Thank you so much, Clark. We really appreciate the time you put into this and everything that you do for us. We do have a couple of questions, and if anybody does have a question for Clark, feel free to stick it in the chat box or in the Q&A. And if we don't get to your question today, then we'll answer it via email later on. But it's actually, the two questions are about the same topic, and it's about the current political climate, all that's happened over the last few months, the market volatility. So basically, how can we use these principles you talked about today to stay disciplined and avoid making decisions that could derail our long-term financial goals?
So there's a lot going on to obviously with tariffs and things like that. And I heard somebody say that markets, when they decline, it's usually some sort of specific global event, maybe something that's going on in the United States. It could be a recession. It could be like 9/11, for example. But the point was made that this is the first time the market has kind of had a little hiccup based on a policy decision by an administration. Now, I'm not saying that this time it's different. Every time somebody says this time it's different, it's not. It's just this is the first time the market sort of had a knee-jerk reaction to a policy decision. The market does not like uncertainty. It likes to have clarity. And so what we saw with when the market had when the tariffs were announced, the market had several days of declines that I'm sure tested our patience and our emotions. But then when they reversed course or paused the tariffs, the market shot up almost 10% in one day. And so imagine if you got out of the market on day 2 after the announcement, and you were not there for that one day return. And that actually turns out to be the 10th best day the market's ever had. So remember all these things that we've talked about. It's a challenge, and it's not like we can't just make it so that we're perfect. We all have these tendencies to maybe have poor behavior. We just have to remind ourselves that this is how markets work. Stay the course.
Excellent. Well, thank you again, Clark, for all of your time today.
Thank you.
And we look forward to seeing you all soon. If you have not responded to our invitation to come to our grand opening, that is May 5th, Cinco de Mayo. And we can't wait to welcome you to our new location. It is our only location. We're not adding a location. It's a new headquarters, and it's at 2500 Daniels Bridge Road. And we're just so excited to show you all that we have going on. Thank you very much, Clark. I hope the rest of your week goes well.
Same to you. Thanks, Betsy.
All right, everybody, take care. Go pay your taxes. Bye-bye.